Welcome to Investing 101, your essential guide to building wealth and financial security. Whether you're a medical professional, a high-income earner, or just starting your investment journey, understanding the basics is crucial. In this video, we'll break down the foundational principles that every investor should know, helping you avoid common mistakes and set yourself up for long-term success. Let's get started by exploring why it's so important to truly understand what you're investing in before you commit your hard-earned money. One of the most common mistakes new investors make is buying into investments they don't fully understand. It might seem obvious, but countless people end up surprised by hidden fees, unexpected risks, or tax consequences. Before you invest, take the time to research and ensure you know exactly how the investment works, what the potential downsides are, and how it fits into your overall financial plan. Remember, if you don't understand it, don't buy it. This simple rule can save you from costly errors down the road. Speculative investments like empty land, gold, or cryptocurrencies don't generate income and carry higher risks. While it's okay to allocate a small portion of your portfolio to speculation, it should never be the core of your investment strategy. Serious wealth is built through disciplined, income-generating investments, not by chasing the next big thing. Keep speculation under 10% of your portfolio and focus the rest on proven, reliable assets. It's a common belief that higher risk always leads to higher returns, but that's not always true. Some risks are simply not compensated, meaning you could lose money without any chance of a higher reward. Think of casino games like roulette, high risk but negative expected returns. The key is to identify investments where the risk is likely to be rewarded and avoid those where the odds are stacked against you. Diversification is a cornerstone of smart investing. By spreading your investments across different asset classes and securities, you reduce the impact of any single loss. Don't put all your eggs in one basket. Investing a large sum in a single stock or loan exposes you to unnecessary risk. Instead, use low-cost index funds or diversified portfolios to ensure your investments are balanced and resilient. Trying to time the market is a losing game for most investors. Instead, invest consistently whenever you have money to invest. This approach, known as dollar-cost averaging, means you'll buy at both high and low points, smoothing out your returns over time. The most important factor is time in the market, not timing the market. Make investing a regular habit and let compounding work in your favor. If you feel compelled to time the market, consider a contrarian approach, doing the opposite of the crowd. Don't rush to buy after a huge price surge and don't panic sell after a big drop. Often the best opportunities come when others are fearful, and the biggest risks appear when everyone is greedy. It's not easy, but being a contrarian can help you avoid costly mistakes. Just because an investment's price has dropped significantly doesn't mean it's a bargain. Sometimes, prices fall for good reasons and further declines can follow. Be cautious about jumping into investments simply because they're cheaper than before. Focus on the underlying value and long-term prospects, not just recent price movements. It's tempting to chase investments that have performed well recently, but past performance doesn't guarantee future results. In fact, asset classes often rotate between winners and losers from year to year. Instead of chasing last year's top performer, build a diversified portfolio and stick to your plan. Over time, this approach leads to more consistent results. Evidence overwhelmingly supports using low-cost index funds over actively managed funds. Index funds offer broad diversification, low fees, and reliable performance that's hard for most active managers to beat over the long run. Unless you have a compelling reason, make index funds the foundation of your investment portfolio. Investing isn't about beating others, it's about reaching your own goals. Once you've achieved your financial targets, consider reducing your risk exposure. There's wisdom in protecting what you've earned rather than chasing ever higher returns. Remember, the goal is to secure your future, not to win a competition. In considering new asset classes for your portfolio, make sure they offer strong returns and low correlation with your existing investments. Don't add something just because it's popular or performed well recently. Each addition should make sense on its own and fit your long-term strategy, not just chase recent trends. Rebalancing your portfolio helps maintain your desired asset allocation and risk level. While it's not necessary to rebalance constantly, doing so every 1-3 years is generally recommended. This prevents your portfolio from drifting too far from your plan and keeps your investments aligned with your goals. There's no single perfect way to invest. Successful investors follow a variety of strategies, but they all have one thing in common: they pick a reasonable plan, fund it adequately, and stick with it. Don't get caught up in dogma or obsess over minor differences in asset allocation. Consistency and discipline matter far more than finding the best portfolio. Occasionally, you'll come across an investment opportunity that seems almost too good to be true. While caution is always wise, sometimes these opportunities are real and worth seizing. Stay alert, do your due diligence, and don't be afraid to act when a genuine $20 bill on the ground appears. Just remember, these are rare and shouldn't be the basis of your overall strategy. True investing success comes from staying the course through both bull and bear markets. It's easy to stick with your plan when things are going well, but the real test comes during downturns. Resist the urge to panic or make drastic changes. Trust your strategy and remember that markets recover over time. Some financial products, especially those sold by insurance companies, are designed to be sold rather than bought. Be wary of mixing investing and insurance. Products like whole life insurance often come with high fees and poor returns. Keep your investments and insurance separate for maximum efficiency and transparency. Take advantage of tax-protected and asset-protected retirement accounts whenever possible. Accounts like HSAs, Roth IRAs, and 401(k)s offer significant benefits that can boost your long-term returns. Don't overlook these opportunities and make sure you're maximizing your contributions to secure your financial future. While minimizing taxes is important, it shouldn't be the sole driver of your investment decisions. The real goal is to maximize your after-tax wealth, not just to pay the least in taxes. Make smart investment choices first, and then optimize for taxes where possible. Just like returns, investment costs compound over time. High fees can erode your wealth significantly, especially over decades. Pay close attention to expense ratios, management fees, and other costs. Even a 1% annual fee can make a big difference in your long-term results. Choose low-cost options whenever possible. Simplicity is often the best approach in investing. Simple, low-cost portfolios tend to outperform complex, high-cost ones, especially when you factor in the value of your time. Don't add unnecessary complexity or chase exotic investments without a very good reason. The majesty of simplicity can lead to better outcomes and less stress. Ultimately, your own behavior is the most important factor in your investment success. Are you saving enough? Can you stick to your plan during tough times? Can you avoid emotional decisions driven by fear or greed? Focus on building good habits, staying disciplined, and making rational choices. The investor matters more than the investment. Congratulations, you've just covered the essential lessons of investing 101. Remember, these principles are the foundation for building lasting wealth and achieving your financial goals. Continue learning, stay disciplined, and don't be afraid to seek guidance when needed. With these basics in hand, you're well on your way to becoming a confident and successful investor.